Welcome to This Explainer. Today, we're dissecting Ferrari's Q1 2026 preliminary results, and honestly, this is a quarter that completely defies standard automotive logic. It really highlights the sheer resilience of their business model. We're going to unpack their revenue drivers, vehicle portfolio, and forward-looking guidance, specifically tailored for our institutional stakeholders. But real quick, before we get into the numbers, please note our mandatory disclaimer. This video is for educational purposes and not financial advice. We are simply here to impartially analyze the reported data and operational strategies straight out of Ferrari's Q1 earnings materials. Okay, let's look at the roadmap for today. We'll be hitting Q1 2026 financial highlights, GAAP to non-GAAP reconciliations, vehicle phasing and portfolio, lifestyle and brand revenue, managing macroeconomic risks, and finally, 2026 guidance and outlook. All right, Section 1, Q1 2026 Financial Highlights. Look at these top-line metrics. They are absolutely staggering. Net revenues hit right around 1.85 billion euros for the quarter. But the real headline here for you institutional investors, it's the profitability. They pulled an exceptional 39.1% EBITDA margin, which translates to 722 million euros. You know, in an industry that's historically plagued by margin compression and massive capital expenditures, pulling a nearly 40% margin is almost unheard of for a physical manufacturer. This figure, along with 653 million euros in industrial free cash flow, shows an unmatched level of pricing power. Ferrari isn't just holding its ground, it's aggressively compounding profitability by leaning into a super-rich product mix. Now, reported revenue growth was 3.2% year-over-year. But here's the kicker. To really feel the operational heat of the core business, you've got to look at the constant currency growth rate, which sits at an impressive 6.0%. This metric is absolutely crucial. It means their core engine is running incredibly hot, easily outstripping the negative hits from foreign exchange rates, especially the US dollar and Japanese yen fluctuations against the euro. And this 6% growth wasn't just some random one-off spike. It was systematically sustained across their key revenue streams. It just proves that their foundational global demand is totally inelastic to currency headwinds. So breaking down that 6% growth shows exactly where the momentum is. Revenues from cars and spare parts crept up 1%, officially passing the 1.5 billion euro mark. And that was heavily driven by personalisations. It's key to remember that Ferrari clients aren't just picking cars off a lot. They're ordering bespoke, high-margin artistry. Every custom stitch, unique paint job, or specialized material, that's pure margin going straight to the bottom line. Meanwhile, commercial and brand revenues spiked 14% to 218 million euros, mostly thanks to strong sponsorships. We also saw a massive 23% jump in other revenues, which we'll unpack in a second, because it reveals a seriously fascinating secondary revenue stream. Moving on to Section 2, GAAP to non-GAAP reconciliations. Diving into the income statement, net revenues landed at 1,848 million euros, while the cost of sales was kept on a very tight leash at 890 million euros. This exact cost control drove an operating profit, or EBIT, of 548 million euros. But what is the absolute most critical takeaway here for any analyst looking at these books? In Q1 2026, Ferrari's adjusted metrics exactly equaled their reported ones. 0 adjustments, impacting EBITDA, EBIT, or EPS. 0. What we're witnessing here is pure, unadulterated operational strength, completely free of one-off adjustments or complex accounting maneuvers. It's a remarkably clean balance sheet. Next up, Section 3, Vehicle Phasing and Portfolio. In the first quarter, Ferrari delivered 3,436 units. Now, their product portfolio had 6 internal combustion engine models, or ICE, and 8 hybrid models. But here's what's interesting. Despite having fewer ICE models available, they accounted for the vast majority of shipments at nearly 70%, with hybrids making up the remaining 30%. This powertrain mix is basically a masterclass in product strategy. It perfectly balances that traditional enthusiast demand for the classic V8 and V12 experience while still pushing forward with their planned technological evolution. A massive driver of all this portfolio excitement and a huge catalyst for future earnings is the F80 supercar. Shipments of this new flagship are currently in their ramp-up phase, completely aligned with management's plans. Alongside the F80, Q1 saw steady, increased deliveries of the 12-cylindry family, the Purosangue, and the SF90XX family. The strategic phasing of high-value, high-margin vehicles is exactly what's keeping that 39.1% EBITDA margin afloat. By deliberately choking supply, Ferrari ensures these models stay hyper-exclusive and highly profitable for their entire life cycle. And the lineup was enriched even further with the start of first deliveries for the Amalfi, the track-focused 296 Speciale family, and the 84.9 Testarossa. Looking a bit ahead, Q1 also saw the global launch of the Amalfi Spider, with distribution slated for 2027. This really highlights the core engine of Ferrari's growth. They never stop refreshing the top end of the market. As older models phase out, newer, highly customized ones seamlessly step in. It basically eliminates the traditional trough you normally see in the auto product cycle. Let's pivot to Section 4, Lifestyle and Brand Revenue. The crucial point here is that Ferrari isn't just selling sports cars. They are actively monetizing the entire aura of the prancing horse. This quarter saw a 14% spike in commercial and brand revenues, fueled by some really high-profile initiatives. They opened a new flagship luxury lifestyle store in London, hosted an exclusive fashion show, and launched the Greatest Hits exhibition at the Ferrari Museum in Modena. All of this drove serious lifestyle licensing revenue. Oh, and that 23% jump in other revenues we touched on earlier, a surprisingly huge part of that came from renting out Ferrari engines to other Formula One racing teams. It's such a brilliant way to offset their massive R&D racing budget while building a totally unique B2B revenue stream. All right, Section 5, Managing Macroeconomic Risks. Ferrari explicitly pointed out that they're operating in a world with incredibly complex geopolitical tensions right now, including the ongoing conflicts in Ukraine and the Middle East. For most automakers, this is a recipe for supply chain nightmares and tanking regional sales. But for Ferrari, total deliveries saw basically zero material impact from the escalation in the Middle East. How? By relying on immense geographic allocation flexibility. When disruptions loomed, they just pivoted, proactively bringing forward deliveries to other eager regions around the world. That level of demand elasticity and supply chain agility is practically unheard of in the rest of the auto sector. And this brilliantly illustrates the ultimate defense mechanism of the Ferrari business model. Despite massive foreign exchange headwinds, like the US dollar and Japanese yen dropping against the euro, and broader inflationary pressures squeezing the global economy, Ferrari just completely protects its profitability. Their secret weapon is unmatched pricing power. Their strict volume control, paired with a rising mix of high-margin personalisations, totally neutralizes those external macro risks. They aren't just selling cars, they're selling highly bespoke luxury experiences that are practically immune to standard market downturns. Finally, Section 6, 2026 Guidance and Outlook. So, after a virtually flawless first quarter, the message from Maranello to the markets is definitive. The 2026 guidance is fully confirmed. They are targeting net revenues of approximately 7.50 billion euros for the full year. They're also projecting an adjusted EBITDA of over 2.93 billion euros, actively keeping that insane margin profile at or above 39.0%. Plus, adjusted diluted earnings per share are forecasted to be greater than or equal to 9.45 euros, with industrial free cash flow expected to top 1.50 billion euros. Hitting these massive targets, despite the global headwinds we just talked about, that's a phenomenal signal of confidence to their institutional base. This robust guidance doesn't come out of nowhere. It rests on some really firm, foundational assumptions. Management expects the rest of the year to be driven by a carefully executed model changeover, giving them a highly positive product mix and continued intense demand for personalizations. They're forecasting higher racing revenues from new sponsorships, a bigger top-line contribution from lifestyle activities, and, crucially, they anticipate that any ongoing global cost inflation will just be completely offset by their pricing power. It's basically the ultimate, perfectly hedged luxury asset playing out in real time. Which leaves us with a compelling thought as we wrap up this briefing. With unmatched pricing power, the ability to reallocate inventory globally on the fly, and a steady pipeline of highly anticipated models, how will Ferrari's continuous product enrichment elevate its luxury status even further beyond 2026? It's going to be a fascinating trajectory to watch. Thank you so much for joining us for this institutional explainer, and please like and subscribe for more videos.